Assessable income, as defined in Section 6-1 of the 1997 Income Tax Assessment Act, includes ordinary income per Section 6-5 and statutory income per Section 6-10, but it excludes any exempt income. One characteristic that can help you identify ordinary income is that ordinary income is often connected with a source, and it will usually involve a flow of cash from that source. Alternatively, periodic receipts may take on the nature of income based on their circumstances. Let's consider an Australian resident named Barry. Barry is an individual taxpayer and works for a small fashion retail business as a sales attendant, for which he receives an annual wage of $40,000. Barry also owns a 50% share in a residential property with his friend Larry. Each year, this property yields total rent receipts of $12,000 and incurs costs of $4,000. Based on this information, what amount would be considered ordinary income and therefore be included in Barry's assessable income? Firstly, consider the $40,000 wages received. This is direct payment for services rendered and is therefore considered to be income from personal services. This is ordinary income and therefore included in Barry's assessable income. Note that any other payments or benefits received that are connected with the provision of this service, such as items of clothing given to Barry at a significant discount or for free, would also likely be considered ordinary income. Secondly, the rental income is income from property. This is passive income, where someone else is paying for the use of the property owned by the taxpayer. Ordinary income often has a flow concept, and the periodic rental receipts represent the return on your investment. Therefore, the gross $12,000 rent receipts are ordinary income. However, in this scenario, as Barry only owns a 50% share in the property, only 50% of the income generated by the property will be included in his assessable income. Let's now think about the income that is generated by the fashion retail store. In this case, the selling of clothing to customers by the fashion store is an activity conducted in an organised way and of a scale that would not be considered for personal use only. Furthermore, the main objective of the store would be to make a profit. Therefore, based on the facts, we can determine that a business exists and that the receipts received by the business are incidental to the conduct of the business. It is worth noting that this determination is based on a question of fact, which differs to a question of law, which is answered by the application of relevant legal principles. Isolated gains from commercial speculation has traditionally been held to be ordinary income, as established in Californian Copper Syndicate and Harris in 1904, where the receipts are not from the mere realisation or change of investment, but derived from an act that constitutes carrying on a business. This concept was extended to involve any commercial transaction entered into for the purpose of making a profit in the case of the Myer Emporium in 1987. Case law also established that periodic receipts which are regular, expected, relied upon and used as a substitute for income, such as annuities or pensions, may also be presumed to be ordinary income. Let's consider a soft drink retailer called BuckFizz. In March, the store had the highest sales turnover for products supplied by a company called Fizzy Drinks. As a result, Bobby Baker, the store manager of BuckFizz, received a prize of 2 free holiday vouchers, entitling the bearer to a $100 discount on accommodation. The vouchers were endorsed with Bobby's name and were not transferable. There was no option to take a cash prize instead. Is this considered to be ordinary income? Income must be in a cash or a money convertible form, and it must come in. Therefore, in this example, the holiday vouchers reduce an outgoing, but money does not come in. And furthermore, the vouchers are not transferable and there is no cash prize option. So the non-cash benefit cannot be substituted for money and is not ordinary income. Lastly, we need to remember that capital receipts and mere windfall gains that are not connected with an income-producing activity are not ordinary income. Capital assets are held for the purpose of earning income or for personal use. If you think about a fruit tree, for example, the fruit tree is capital and the income is the fruit sourced from the tree. This goes back to the flow concept. Income represents the return on the investment, whereas any return of funds by way of capital receipts is a return of the investment. Mere windfalls, such as lottery winnings, that are not connected with an income-producing activity are also not considered to be ordinary income. The key aspect to this is the full circumstances in connection to the gains. If a connection can be made with an income activity, then the gains may be considered ordinary income. For example, sports prize winnings received by a professional sports person. In this clip, we have provided an overall summary of ordinary income as per the Income Tax Assessment Act of 97, Section 6-5, by providing some high-level examples to illustrate the key characteristics of what is considered to be ordinary income and also what is not. It is important to remember that ordinary income often flows from a source and that case law is relied upon as guidance.